All right, and we are live. Hey, everybody, Smart Silver Stacker here. So it's not looking good, folks. We just got a warning from the Federal Reserve, and they're telling us what their plan is as they move forward here. And it's looking more and more like the Federal Reserve is intent on driving this economy off the edge of a cliff, and it's going to lead us to a very bad place in these markets in the near future. There's a lot of signs of that. I want to go over those in today's video. First of all, I want to start off with this warning that we just got today from these Fed officials. Here's the headline from Yahoo Finance. Fed officials warn rates may rise again and stay higher for longer. So, we had the FOMC conference just a couple days ago with Jerome Powell telling us that inflation has come down. They've made all this progress in their inflation fight, but now sounds like some of the other officials being a little more realistic and telling us what's going to happen here moving forward. So federal officials offered new warnings Friday that they could raise interest rates again and hold them at higher levels for longer to return inflation to the central bank's 2% target. Now, I don't think that there's any chance the Fed is going to get inflation down to 2% with just rate hikes, but that seems to be what they think is the magic pill for this inflation problem that we're experiencing here in this economy. Fed Governor Michelle Bowman said inflation remains too high despite considerable progress, and she continues to expect to raise rates further and hold them at a restrictive level for some time. And this is a quote from her. She said, "We should remain willing to raise the federal funds rate at a future meeting if the incoming data indicates that progress on inflation has stalled or is too slow to bring inflation to 2% in a timely way." I feel like data already indicates that progress on inflation has stalled. If you look at the latest readings from the CPI, 2 months in a row, we have seen increases in headline CPI. So, yes, inflation may continue to tick up. I certainly think that that is in the cards. But the Fed's reaction here is that they're going to hike rates more. Now, Powell did tell us that we likely could see another rate hike before the end of the year. But it sounds like these Fed officials are getting even more hawkish. So that was Fed Governor Michelle Bowman, who said that she expects inflation to stay above the Fed's target of 2%, at least until the end of 2025. But then we had another Fed official, Boston Fed President Susan Collins, who is also getting more hawkish. She said this: "I expect rates may have to stay higher and for longer than previous projections had suggested. And further tightening is certainly not off the table." Now, I want to borrow a phrase here from Greg Manarino, when he says, duh, because I think it's pretty obvious that no matter how high the Fed moves rates, this inflation problem is not going to be fixed until the real culprit is addressed, and that is the massive deficit spending in Washington, which I do want to get into in just a moment. But just to wrap up the information in this article, they said, let's see, who was this? This was San Francisco President Mary Daly said, "While inflation is coming down without a large disruption in the job market, it's far too early to declare victory. We need to see if more is necessary or if we can simply hold where we are. What we did at the meeting this week is not a predictor of what we'll do at the next meeting. It's just a sign that we are getting close to our destination of where we will peak the rate. We need to go at a slower pace." Now, on that note, I want to point out that I don't think that the Fed is doing this necessarily because they think they need to go at a slower pace. That's what Powell told us, that he fears over tightening. But I think what it is that the Fed has very little confidence in this economy's ability to weather these higher rates. But judging from what these other officials are telling us, we are going to see much higher rates in the near future because, I expect inflation data to continue to get worse. And that means, according to these folks, the data-dependent Fed, they're going to be hiking rates even more. And that's a huge problem for this over-leveraged economy. It's going to bring this economy to its knees. Now, one thing you might want to have if we do witness this type of collapse that this is putting us on track for, some hard assets, gold and silver. Buy your gold and silver at sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. And, that's today's video sponsor. You can check them out in the link in the description. That's where I buy my gold and silver. I do want, before we address the issue of, the real cause of inflation and what this means for the economy, that the Fed is going to continue hiking rates, I do briefly want to just go and take a look at some of the market data that we got today. So silver actually remarkably resilient today. It was in the red a little bit yesterday following that announcement that they were going to be keeping rates flat, and we saw, markets not liking that at all. Pretty much everything across the board was selling off yesterday, silver included, but remarkably strong today. I think we might just be getting a bit of a breather here. We had the 10-year Treasury rate also declining today, so someone was in the market buying bonds. I mean, who do you think that was? You think it was investors? You think it was China? No, I don't, but somebody was buying it. So leave me a comment down below to let me know who you think was buying these 10-year bonds, because we did see the rate falling today. But any reprieve that we're seeing in the markets today and in the debt market, I think, is going to be short-lived because the Fed hiking rates further is a very ominous sign for an economy with the levels of leverage and debt that this economy has. And on that note, I want to some of the information from Treasury here regarding the U.S. debt really getting out of control. I mean, it seems like every time I look at his site, the data just is shocking. And this is the reason that inflation is going to continue spiking up, and it's also largely why higher rates are going to be so destructive for this economy, because when you have the level of debt that we have here, servicing that debt becomes untenable as the Fed continues to hike their federal funds rate up. So this is the most recent data from the Treasury on the debt to the penny website. You can see it goes back on the first page here to September 14th. The most recent data from September 20th. Now, I want to examine this because it's really quite impressive how quickly they've managed to run up the debt now. If you go back to September 14th, that was the day before we crossed the $33 trillion mark. So now we're much higher than that. We're up to something, 33.07 trillion. This is an increase in the debt at a rate of hundreds of millions of dollars per hour. It is an absolute incredible pace if you just do the math. Just do the math from September 15th to September 20th. Look at the increase. It's incredible. And that's not even the most recent data, of course. You've also got more recent data from the U.S. debt clock. This is up to date for today, September 22nd. 33.099 trillion. So we're almost at 33.1 trillion. And it was just a week ago, really, that we crossed that $33 trillion mark. So, if you annualize this rate of deficit spending over the past week, it is, I think it's somewhere around $4.5–5 trillion, the pace at which debt is being piled on, and the rate at which the Fed, or rather the Treasury, is selling new debt into the market. So, rates on U.S. Treasuries, those are going to continue moving up. It's almost guaranteed by the fact that the Fed, or rather the Treasury, is continuing to sell debt. And of course, the Fed is as well as foreign investors in U.S. like China and Japan. They're all liquidating debt at the same time that the Treasury has these massive issues of new debt. This is going to drive rates up, and this will become untenable. Now, I don't know what's going to break. There's a long list of potential black swan events, potential critical events which can occur in this economy. It could be the over-leveraged U.S. consumer who now has over $1 trillion in credit card debt. It could be the student loan payments beginning in October, just causing a cascading series of defaults on consumer debt. It could be the banks who, every time the U.S. Treasury's yield increases, their losses on their bond portfolios are magnified significantly, and there's the risk of more banks failing and requiring bailouts. It could very well be the abandonment of the petrodollar. The geopolitical situation is not looking good. You've got foreign holders of U.S. debt dumping their treasuries. At the same time, you've got Saudi Arabia and Iran, these OPEC nations, joining BRICS, and they may very well abandon dollar pricing for their oil exports. That would be a significant factor for inflation. You'd see a lot of dollars flooding back into the U.S., driving inflation even higher. What will the Fed do when inflation soars and their rate hikes don't work? Well, I mean, I think when these markets crash, and I do think that we are at risk of a major sell off right now, when you see this kind of hawkish talk from Fed officials talking about hiking rates, even though, we've already got rates being raised at a record pace, and banks, consumers, everybody's coming under a lot of pressure. They're going to hike them more. So I really think that we are at risk of a significant sell-off in these markets. That, of course, will trigger the Fed response, the massive creation of money. Because as long as the government is running these deficits, there's very little hope that inflation is going to come under control. When you look at these numbers, national debt of $33.1 trillion, just about, you got to understand that there's only two ways that you can pay for this kind of debt. One, you have to slash spending, you got to end the deficits, you got to jack up taxes, and you got to pay this off. The other way, of course, is to devalue the currency and pay the debt off in devalued currency. It's the only two ways. And you pay the debt via inflation or via taxation. And inflation really is just a hidden tax that penalizes anybody who's holding the currency, who's holding US dollars. And so, my bet is that they're going to pay for this via inflation. I just don't think there's any political will for the opposite. But in the meantime, the Fed seems intent on destroying this economy and bringing these markets to their knees. Now, we got an interesting warning recently from Ray Dalio. He said that he preferred cash over bonds. That's what he was buying. So he thinks that rates could continue to move much higher. And I do agree with him. I think that there is a lot of pain still in store. But recently, just the other day, he was speaking at the All In Summit 2023, and this is the headline: a rising U.S. national debt may force another move to print money, says billionaire investor Ray Dalio. And I'll come to the quote here from Dalio at this meeting, but it really gives you an indication of where we are headed. So Dalio warned that this situation of $33 trillion debt and growing poses a significant risk for the U.S., particularly for those holding U.S. bonds. He explained that if the government prints more money, the dollar's value would decline, thereby affecting the value of U.S. bonds. This could result in bondholders selling off their assets if they perceive that the returns are no longer attractive. And that's exactly the kind of sell-off that could trigger spiking rates. And then, that's when the Fed is forced to intervene in the markets and come in and monetize debt. And that's exactly what Dalio is warning against. This is what he said exactly, a quote from him. The big risk comes when they don't want to hold those bonds anymore because of the supply and demand. Because when a country has a deficit, it has to borrow, and so it sells its bonds. Who are the buyers of the bonds? Why do they buy? The buyers of bonds buy because there's an attractive return. Not only do you have those amounts of bonds, but when they start to realize that they're not getting good returns on those bonds, they can sell those bonds. And yeah, I mean, it makes a lot of sense. If the Treasury is continuing to create these bonds, sell them out into the market, when the supply of something increases, its value declines. And you got to remember, when rates are increasing on bonds, that means that the bonds are actually declining in value, the existing bonds that have the lower coupon. So when you see a sell-off in bonds, when you see supply of bonds increase and demand decline, the rate is what moves up. And that is to incentivize new buyers to come into the market and buy up the debt. Well, right now, you've got a lot of folks around the world selling bonds, and that is causing them to lose their value. That is why we are seeing the 10-year Treasury moving up 3 years in a row, an event that hasn't occurred since 1787. That is why you are seeing the rates move up on these treasuries, because they have to in order to incentivize individuals to still come out and purchase them. And if the Fed is hiking up their federal funds rate even further, and they're still continuing their program of quantitative tightening, reducing their balance sheet, that is going to move the yield on bonds even higher. And again, that's going to put a lot of stress on a lot of folks. We've already got the debt service payments on the national debt approaching $1 trillion. You have banks with multi-trillions of dollars in losses, unrealized losses, on their bond portfolios because they're holding these bonds with very low yields, probably close to 0%, 1% yield, half a percentage yield. They loaded up on these things during the pandemic when bonds were brought artificially low. The yield on them was brought artificially low because the Fed was buying trillions of dollars of bonds, suppressing the interest rates, stimulating the economy. And now that these rates are moving back up, a lot of folks are in trouble. I mean, the federal government, for one, of course, they can always just continue selling more bonds. They can have the Fed monetize the debt, but the banks can't do that. I mean, the banks probably at the end of the day are going to get a bailout. They're going to need one. The Fed will be taking all of those assets that the banks are holding onto their balance sheet. We got a preview of that earlier this year with the Bank Term Funding Program, where they allowed the banks to put up all of those bonds as collateral for loans. But they put them up at their face value, which is significantly higher than the real value in the marketplace. So it was sort of a bailout light. And I think that we're going to see a lot more of that. And Ray Dalio is very right to be warning folks who are holding bonds. And this is kind of a self-fulfilling prophecy as you see folks start to sell bonds and the yields are moving up. You're going to see more holders of the foreign holders of bonds, like China, for example, trying to unload their U.S. treasuries. One, because their holdings are devaluing as rates rise, and also they don't want to get paid back in devalued currencies because they understand that there's no way that the federal government, the U.S. government, can pay off this debt without printing the money. And that's what Ray Dalio is warning about here as well. That's what we're headed towards. Now, I think probably what the Fed is playing at here with all of these rate hikes, I mean, they have to understand that this isn't going to work to fight inflation. They understand that with the government run, trillions of dollars worth of deficits on an annual basis, they're not going to bring inflation under control. That's all money that is being borrowed from the future and spent into the now, leading to higher inflation. So that's not why they're hiking rates. Why are they hiking rates? Well, I think they want the excuse to use the tool that they like to use the most, the printing press. They need a crisis. They need a sell-off across assets. They need a bank failure. They need a consumer who is at the end of their rope in order to initiate the printing operation. Here's the thing. When the Fed resumes printing and they start the QE again and they start slashing rates, the American people are going to be begging them for it. They're going to want stimulus checks. They're going to say, we need stimulus checks to bail us out from inflation. I mean, as crazy as that sounds, that is the direction that we are headed in. They're going to make it look like it'll be doomsday if they don't print money. And, they may have very well backed us into a situation where it will be doomsday if they don't run the printing presses. But here's the thing. I mean, there's only so far you can kick the can down the road. And previous stimulus has been so massive that when they do kick the printing presses off again, it's going to be in a grand style. And I think that that's when you're going to see the price of hard assets like physical gold and silver soaring. I think that in an environment like today, maybe this is the appropriate coin to hold up here, the 5-ounce Aztec calendar silver round, because this thing has a bit of an apocalyptic feel to it. And, I'm not trying to be like Chicken Little saying, oh, the sky is falling, it's all doom and gloom, but right now things aren't looking good. I mean, we got inflation resuming its upward movement for the past 2 months. I don't think that's going to change anytime soon. That's not a coin, it's a plate, mate. Yeah, got that in the chat. That's funny, man. This thing is kind of like a dinner plate. And, hey, silver is antimicrobial, so you could eat off of one of these and be completely safe. But that might be the more appropriate coin. It has kind of an apocalyptic feel to it, that Aztec calendar. And it does seem like we are approaching a significant shift here in the global economy. We got some news today out of England that layoffs there are accelerating significantly. You've got Putin cutting off diesel exports to Europe. You got the price of diesel soaring now in global markets. Even in the U.S., it's rising. And it's not looking good. You got inflation it's not going to get under control. It's going to continue to move up. The Fed, in their misguided attempt, or maybe it's not misguided. They're not idiots. They're whatever you want to say about them. I think they know their game. They're setting us up for more money printing in the future. But it's going to have to get pretty ugly before they can do that and do it, in a way where people aren't blaming them for the inflation that's coming. Someone asked in the chat there, what do I think about Peter Schiff? I don't know. I like Peter Schiff. I think that he has an Austrian approach to economics, which is a pretty solid way to look at things. He's been calling for people to get into hard assets for years now, and I think Peter Schiff was maybe a little early in calling for what he's been calling for, but ultimately, I do think that the voices of reason out there, like Peter Schiff, will be proven right in the economic arena. Of course, the Fed and the powers that be are never going to acknowledge it. They will always find some culprit. They'll have some excuse why inflation is soaring despite their rate hikes. They'll never acknowledge that it's the deficit spending either, because here's the thing, if Powell comes out and criticizes the Biden administration and Congress for their level of deficit spending, they'll just get replaced. The Fed is supposed to be apolitical, but they're anything but. They typically play ball with whoever's in office. This guy was put into place by the former president, and he kind of towed the line there, and he's toeing the line for Biden as well. He's not criticizing the federal government for their deficit spending at all. He claims that, it's all the Fed trying to be apolitical, but at the end of the day, I mean, these central bankers, they're just lackeys, I think, of the powers that be. And it's not like, the guy in the White House is calling the shots either. But it's the financiers, it's basically a plutocracy is what that's turned. And what we're going to see when these markets crash and then the Fed prints a bunch of massive wealth transfer. You're going to see people's 401ks wiped out. You're going to see people's savings accounts wiped out because the purchasing power of the currency will decline. And, the CEOs of the banks, they're going to get golden parachutes if anything fails. And really, I just want to have assets outside of this financial system at this point. I mean, it's clearly rigged against the average person. And I think one of the best ways to become your own central bank and get assets out of the system is to get gold and silver, these assets that you can hold that don't have counterparty risk. The Fed can't come out and change the rate on your silver. They can't do a bail-in with your silver. I mean, I guess, some people warn about confiscation. I see comments about that a lot about, oh, they're going to confiscate your silver. It's like, well, look, they're already confiscating your purchasing power of your cash via inflation. So even if you take your cash and stuff it under your mattress, it's still going to devalue. And yeah, I mean, it's not outside the realm of possibilities that they roll out a CBDC and a totalitarian control grid. I mean, this video is probably going to get demonetized now if I start talking about this stuff, but I will say that at least with gold and silver, the logistics of a confiscation tends to favor the stackers, I think. Believe it or not, I think stackers in any significant quantity, of metal are probably a fairly rare breed out there. Not too many people are getting into hard assets yet. I do think there will come a time when folks are piling into them as they run for the exits, but that time hasn't come yet. And stackers are small fries compared to what they're going to be doing. So I'm not too worried about silver confiscation. There's always the old boat accident adage. A lot of people are fond of saying that. And I mean, there's something to that, right? It's like, oh, I don't know where my gold and silver is. I don't know where it went. I lost it. It was stolen, whatever. Can I write it off as a loss now? So, again, the logistics kind of favor you as a stacker. Although, there are incidents in history. I've read stories about in China, for example, the communist revolution under Mao. Landlords had gold and silver, mostly silver dollars. They had them, and I've read accounts of the peasants having these like uprisings and state-sponsored uprisings at the hand of the Chinese communists, and basically murdering all of the landlords and forcing them to reveal the locations of their hidden stashes. And then being basically just executed by these crowds. So it's like, yeah, gold and silver, sure, you got to have them. You also got to have some security and some means to protect yourself. But luckily for us in America, the founders were smart enough to preserve that right for us in the Constitution. If you know what I'm talking about, again, I don't want to get the video demonetized, but there's a list of rights that are granted to folks, and the second one is something that can help protect you against things like that. So, will there be confiscation? I don't know. I don't sweat too much about that because there's guaranteed going to be confiscation of your fiat currency. It's already happening. The purchasing power is being inflated away. So, I mean, inflation is basically just wealth confiscation and wealth transfer. So if you want to at least have a fighting chance against that, hard assets are probably a good thing to get your hands on. And right now, I am also thinking it's probably wise, as Ray Dalio has told us, probably wise to have some cash because, if the Fed keeps hiking rates, I do think we are at a serious risk of a catastrophic sell off in these markets, and that might be the trigger for the Fed to begin printing again. But you might have an opportunity to snatch up some very cheap assets. We had a really nice opportunity in 2020. The spot price of silver declined to something like $12. Now you couldn't buy physical for $12 because the premium soared at that time as well, but you could still get a nice deal on some physical. And then, in things like energy, I mean, there was a period in 2020, it shows you how wacky this manipulated economy is, where you had the price of oil dropped into a negative level because they couldn't find storage for it, because there was this artificial shutdown of the economy, and they needed to suddenly find a spot for all this oil that wasn't getting refined because nobody was burning the oil and the refined products. But there was a huge opportunity there to get in on energy stocks and producers. They just basically, when you have a manipulated economy like this, you can kind of expect large volatility and significant movements. And, if you want to be prepared to take advantage of those, one thing you can hold is precious metals, but I think another thing is some cash that you want to have. You want to have some dry powder ready for if there is some kind of a collapse in asset prices, because any asset price collapse is going to be short lived. The Fed will intervene eventually. They're just going to wait until the American people and the politicians that we put into office are begging for it. You've already got, folks from the extreme left, like Elizabeth Warren, writing letters to, the Treasury and trying to encourage the Fed to stop with their rate hikes. And, she's basically a monetary theorist. And of course, if the Fed were to stimulate right now, inflation would run out of control, but I think that's probably going to happen anyway. And so, if that's the attitude now, when things are relatively good, I mean, compared to where they're headed, imagine what the politicians will be calling for once the economy really begins to break. And that could happen anytime. I mean, it could happen tomorrow. Will it happen today or tomorrow? Chances on any individual day are low. But as we keep seeing the debt increase and we keep seeing inflation rise and we keep seeing rates move up, it's only a matter of time until something breaks in this economy. I mean, again, I've enumerated a long list earlier in this live stream of things that could potentially break, and then the real black swans are the ones that you don't even see coming. But the problem is that when you have so much debt and so much leverage in your economy, and you've outsourced all of your actual manufacturing jobs, and you have these great jobs numbers they're talking about. It's a bunch of broke people going and getting, waitress and waiter and bartender jobs in the service sector because they can't pay their bills because of inflation. It's not a sign of economic strength, folks. It's a sign of fragility. And when you have a fragile economy like this and you get any kind of unexpected event, the fallout from it can be disastrous. And that's why I'm just fairly convinced that we're going to see a major negative event here in the relatively near future, and that is what is going to coax the Fed to reverse their tightening. They're going to stop raising rates. They're going to start buying up assets again. I mean, think about this. The Fed has been doing quantitative tightening now for several months, and they've gotten down from just under $9 trillion down to about $8 trillion on their balance sheet. And look at what has happened to the rates on U.S. Treasuries. Imagine how high the rates on U.S. Treasuries would be if the Fed were to sell off the remaining $8 trillion worth of assets on their balance sheet, a large number of which are U.S. Treasuries. And the rates would spike through the roof. No way the Fed can normalize its balance sheet without destroying this economy. And that's why they're not going to. They're going to ultimately fulfill their role as the buyer and lender of last resort, and inflation is going to become an afterthought to their other mandate, full employment, or, keeping the banking sector from imploding. That's not their stated mandate, but at this point, that's basically what they're doing. And I don't think that they necessarily have a long-term plan, except for the fact that they're trying to kick the can down the road, keep this thing running as long as they can, and transfer a lot of wealth from the American people to the folks who are running the show. And the way they can do that is run the printing press, and that's why that's where we're headed. So anyway, this has gone on long enough, but I do appreciate all of you joining today's live stream. If you got some value out of it and you enjoyed it, please do give it a big thumbs up down below. Consider subscribing to the channel if you haven't yet. And with that said, I will catch you next time. Stay safe, everybody. Happy stacking. Smart Silver Stacker.